Ladies and gents, a very warm welcome to our channel Polo Vega. On today's video, we shall talk about various strategies that we use for trading options. Options can be traded in multiple ways. They can be traded as naked options. They can be traded with the underlying asset. They can be traded with other options with both short and long positions. Therefore, we shall divide the topic in two different videos. In the first one, we shall talk about the simpler ways of trading options, and in the second one, we talk about the more complex strategies. But before we go on to our video, let's look at the disclaimer/disclosure clause. Disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 12th of a series of interactive videos aimed at educating our viewers about various option trading strategies using call and put options with same/different strike prices and or same/different expiration dates. Call option. A call option is a financial contract giving the buyer the right but not the obligation to buy the underlying asset at a specific price on or before the expiry date. The European option is allowed to be exercised only on the expiry date, while the American option allows the buyer to exercise it on or before the date. The writer or the seller of the call option has the obligation to deliver the underlying asset at the strike price if the buyer exercises the call option. The diagrams attached show the profit and loss made when the current market price moves up or down and when you go long, a short or call position. Profit and loss from buying/selling of a call option. From the profit and loss chart of the long call on the previous slide, we can see that the buyer of the call option breaks even when the difference between the current market price and the strike price is equal to the option premium paid to buy the call option. When the current market price of the underlying asset starts to go up, the buyer does not start making profit until the difference between the current market price and the strike price exceeds the option premium paid. Thus, we can see that there is no limit to the profit that can be made, while the maximum loss is limited to the value of the option premium paid by the buyer. From the profit and loss of the short call on the previous slide, we can see that the seller of the call option is in profit until the difference between the strike price and the current market price is less than the option premium paid. If the current market price of the underlying starts going up and the difference with the strike price exceeds the option premium, then the seller can have an unlimited loss. Thus, profit is limited to the option premium received when the market price stays below the strike price, while the loss is unlimited as the current market price starts climbing above the strike price. Therefore, one can see that the selling of a naked option or an uncovered call option carries higher risk owing to an unlimited downside if the market reverses its direction against the seller's prediction. Put option. A put option is a financial contract giving the buyer the right but not the obligation to sell the underlying asset at a specific price on or before the expiry date. The European option is allowed to be exercised only on the expiry date, while the American option allows the buyer to exercise it on or before the date. The writer or the seller of a put option has the obligation to buy the underlying asset at the strike price if the buyer exercises the put option. From the diagrams attached, we can see the profit and loss made as the current market price goes up or down and one takes a long or a short position in a put option. Profit and loss from buying/selling of a put option. From the profit and loss chart of the long put on the previous slide, we can see that the buyer of the put option breaks even when the difference between the strike price and the current market price is equal to the option premium paid to buy the put option. When the price starts to go down, the buyer does not start making profit until the difference between the current market price and the strike price exceeds the option premium paid. We can see that there is no limit to the profit that can be made, while maximum loss is limited to the value of the option premium paid by the buyer. From the profit and loss of the short put on the previous slide, we can see that the seller of the put option is in profit until the difference between the current market price and the strike price is less than the option premium paid. If the current market price of the underlying starts going down and the difference if the strike price exceeds the option premium paid, then the seller can have an unlimited loss. Thus, the profit is limited to the option premium received, while the current market price stays above the strike price, and the loss is limited or unlimited as the current market price starts going below the strike price. Therefore, we can see that selling a naked or uncovered put option carries very high risk owing to an unlimited downside if the market reverses its direction against the seller's prediction. Bullish/bearish strategies while trading options. When the market is expected to go up or is already in an uptrend, one can use the following strategies to get into bullish trades using naked or put options. The simplest way to enter into a bullish trade when the VIX/Vega/implied volatility is low is to buy an in the money/at the money/out of the money naked call option. The choice of buying an in the money or at the money or out of the money naked call option determines the probability of the success of the trade and also the profit of the trade. This part we will address when we start implementing the strategy. The second bullish trade is to sell an in the money/at the money/out of the money naked put option when the VIX or Vega is high and the option premium is inflated. The intention is to retain the option premium when the current market price stays above the strike price. When the market is expected to go down or is already in a downtrend, one can use the following strategies to get into bearish trades using naked call or put options. The simplest way to enter into bearish trade is to buy a naked in the money, at the money/out of the money put option when the VIX or Vega or implied volatility is low. The second bearish trade can be entered by selling an in the money, at the money/out of the money naked call option when the VIX or Vega or implied volatility is high and the option premium is inflated. The intention is to retain the option premium when the current market price stays below the strike price. Combining options to reduce downside risk and maximize return. As discussed on one of our earlier slides, there's an unlimited risk while selling call or put options if the trade happens to go in the adverse direction. Therefore, one needs to be extremely cautious while placing sell trades or going short on call or put options. In order to reduce the risk and maximize returns, one can use various strategies to combine the option trade with other positions in options on the same underlying asset with expiry dates which are different or same expiry date, different strike prices or same strike price, or taking options positions while holding positions on the same underlying asset. Covered calls, married puts, collars are used when one already has a position on the underlying asset. Spreads involve buying one or more options and simultaneously selling another option or options. Long straddles or strangles profit when the market moves either up or down. Barfly, iron condor, and iron barfly use simultaneous buying and selling of multiple options. On this video, we shall talk about various ways of entering into long or short positions on naked options and then explore the possibility of combining various options in our next video. On our last slide, we saw that different types of options can be combined together to reduce the risk or change the risk to reward ratio of an option trade. But before we go on to the combination of various options, we would first like to see the buying and selling of simple options which are call options and put options. Buying a call option is a bullish trade while buying a put option is a bearish trade. Although the two trades are opposite in direction, but one needs to know that the two follow similar principles at different market conditions. Since you're buying an option, it's always more profitable to buy an option with higher delta so that you can profit more from the movement of the price of the underlying in your favor. So it's always better to buy a one in the money or two in the money option rather than buying an out of the money or at the money option, which have a very low probability of profitability at expiration. Since time decay of theta works continuously against the option buyer, one needs to buy a quarterly option at least 60 days before its expiry so that there is enough time for the underlying and the option to move to the desired target position. Since Vega or implied volatility plays a very large role in the prices of option premiums, it's always advisable to buy them at a time when the implied volatility is low and sell when the implied volatility inflates the option premium. The other factors like gamma and rho do not play a major role in the option pricing unless the government suddenly decides to change interest rates or the rate of change of delta shoots up suddenly. The trades involving the selling of naked call or put options are totally different from that of buying naked call or put options. Selling a call option is a bearish trade while selling a put option is a bullish trade. These two trades are extremely risky trades as the loss in both cases is unlimited. Since profit is limited to the size of the option premium against the loss that one can incur if the price goes indefinitely up or down against the intended direction of the trade, one would like to sell an option when the premiums are inflated. A deep in the money option will have a very high intrinsic value and delta, but the probability of the option expiring worthless or the trade being profitable is little or negligible if one tries to sell an in the money option. Hence, we should try to sell an at the money option or one or other money option which would have a better chance of going unexercised or expiring worthless. Since time decay or theta works in favor of the option seller and the gradient of the curve is steepest towards the end of the contract, one needs to sell a quarterly option as close to the expiry date as possible, preferably no further out than 30 days before its expiry, so that the extrinsic value decays as quickly as possible and the option expires worthless if the direction of the trade is correct. Since Vega or implied volatility plays a very large role in the prices of option premiums, it's always advisable to sell the options at a time when the implied volatility is high so that the option premium is inflated at the time of making the trade entry. The other factors like gamma and rho do not play a major role in option pricing unless there are sudden and unexpected changes in the geopolitical or an economic environment. We hope that you enjoyed our short video presentation on basic option trading strategies, their risk versus reward profile, and the role of delta / in the moneyness, theta / time decay, and Vega / implied volatility while buying or selling an option. In our next video, we shall touch upon the combination of two or more options which can reduce the risk of option trades and improve the profitability of trades as compared to the risky positions that one can get into while selling naked options. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us on our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. Please keep saving, keep investing, and keep getting wealthier until we meet next. We thank you and look forward to see you and interact with you on our next video on option strategies with different combinations of put and call options to make them more exotic.